Muted.
Hello and welcome to our webinar, and thank you for joining us. I am Lexi Herndon, Outreach Coordinator at the Environmental Finance Center at UNC-Chapel Hill. Joining us today are Jeff Hughes, Director of the Environmental Finance Center, and Chris Clement and Chris Wedding of Iron Oak Energy. Before we get started, I just want to go over a few technical details with you about the GoToWebinar platform. This webinar is being recorded, and we will share the recording and the slides from the presentation with you later this week. The webinar will last for 1 hour, and we'll have some time to answer questions at the end. All participants will be muted throughout the webinar, so to ask questions, please type them and submit them in the questions box that appears on your screen. Feel free to submit your questions at any time. We will queue your questions and answer them at the end of the webinar. If at any point you have any technical problems with GoToWebinar, please send us a note in the same questions box. I will be monitoring this box continuously and will communicate directly with you there. Once the webinar ends, you will automatically be sent to a brief 5-minute survey. Your feedback is very important to us, and we'll use your input to help us improve future webinars. Thank you very much in advance for filling out the survey. And thank you all for joining us today. We have just over 150 registrants of this webinar kind of spread out throughout the country, and just a few from other continents as well. So we're really glad to have you all on board with us. And before we get started, we just want to get to know you a little bit. So I'm going to launch a polling question here. So just asking who you work for here. Take a few minutes to respond. All right. I'm going to go ahead and close the poll and share the results now. So we have about a third of you from local governments, and another large chunk of you are from organizations that advise potential issuers. And then a few more of you from state governments, and some from nonprofits, and nobody from a for-profit potential bond issuer. And just one more poll question here. So would you describe yourself as more of a finance professional, a public administrator or generalist, an environmental manager, or an environmentalist? Okay, we've got lots of votes coming in here. I'm going to go ahead and share the results. All right, we have a pretty even spread here. So lots of finance professionals, lots of environmental managers, and some public administrators. So thank you all for joining. And I'm going to go ahead and turn it over now to Jeff Hughes. He's going to kick it off.
Thank you very much, Lexi, and really happy to see the diversity we have in our participants today. That we really like when we get a diverse crowd, and we hope that you'll, as Lexi said, you'll have some questions at the end, and they'll come from your different perspectives so that we can continue to kind of understand the different diversity of opinion and perspectives around this very interesting issue. So I'm going to talk a little bit about introduction to green bonds, some very basics, and then I'm going to pass it over to my colleagues are going to talk a little bit more about the process for issuing green bonds. Just before I start, a word about the Environmental Finance Center. If you're not familiar with us, we're situated in North Carolina at the University of North Carolina at Chapel Hill. We're a relatively small group that focuses on applied research, teaching and outreach, and program design and evaluation, all with the goal of helping communities figure out fair and effective ways of providing environmental services. And it's all types of environmental services. We work in the water sector, the energy sector, land conservation. We're also part of a network of environmental finance centers. Some of you from other parts of the country might be familiar with some of our sister centers that are spread out. We and our sister centers provide a variety of specific services. I'm going to allude to a few of them during the presentation, but we do a lot of our research in the form of blog posts. We do standard research projects for a variety of different clients, direct advising. We maintain a number of outreach services, including listservs that those of you in North Carolina are probably familiar with, such as Green Gov, Stormwater, and Water listservs. And then, of course, we prepare guidance documents on various topics, and we do quite a few education events like we're doing today. This webinar is also part of a program called the Southeast Energy Efficiency Finance Network, which we are a partner with one of our sister organizations out of Atlanta, the Southeast Energy Efficiency Alliance. Together, we've created this network to really serve as a platform for peer exchange, for notifications about new practices in the energy efficiency space. So we're happy to be partnering with the network for this particular event. Just some other quick acknowledgments before we get started. We are funded heavily by the U.S. Environmental Protection Program. It's actually their funding that created the Environmental Finance Center Network, and we're very grateful for them. And as I mentioned, some other partners that have helped us do some of this research and some of the work, including Southeast Energy Efficiency Alliance, the Energy Efficiency Finance Network, and then our friends from Iron Oak Energy, which you'll hear from in a minute. This is really designed to be a very basic overview webinar. Green bonds is a huge topic. We're trying today to just give you all an overview of what makes a bond green, provide some examples of green bonds that are out in the marketplace, describe some of the processes that go through the issuance of a green bond, and then really, we hope to start the process for sharing information, soliciting your views about what kind of things you're seeing out there. So there will be some opportunities for you to participate in polls and to ask us questions at the end. Speaking of polls, we wanted to find out where everybody's coming from with their familiarity with green bonds. So please take a second and answer the question that you'll see up on your screen. They're coming in. Okay, so I think we designed a webinar that is fairly aligned with the audience. I think quite a few folks, this is the first time they've really been exposed to green bonds. So you will find that we're going to be providing some basic overviews. For those of you that have issued a green bond, some of this might be review, but hopefully we'll present it in a way that will have something to offer for you as well. I will say that green bonds is a very exciting topic. There's a lot of organizations that are working on this area. If you're someone that after today's webinar really wants to dig in, I'm suggesting at least one website to consider going to. Climatebonds.net is an excellent resource for all things green bonds. And a lot of the examples that we're going to be talking about today came specifically from their database of green bond issues. So again, if you want looking for one place to spend a number of hours, if not days, reading about green bonds, I suggest you consider going there. For those of you that are not that familiar with the finance world and aligned yourself more in the environmental space, you may not be aware of all the nuances of bonds. There are a lot of ways of referring to bonds. You can characterize bonds based on what is the security behind the bond. In other words, what backs the bond? And you'll hear phrases like revenue bonds, general obligation bonds, limited obligation bonds. That's one way to think about the bond market. There's also a way of characterizing bonds based on who issues the bonds. Is it a private entity, a corporation? Is it a municipal bond? Now, most of you on this call are coming from the municipal governmental space, but there are some active green bond issuances going on in the corporate bond space as well. You can use bonds to refund existing debt, just like you would refinance a house. You can go out, and if you have existing debt, you can go ahead and issue a new bond, particularly if the interest rates are more favorable, which they have been for the last couple years. You can also use a bond for a brand new project. Then some people just talk about bonds based on the type of project. Is it a water bond, a sewer bond, that sort of thing. And then for many, particularly those that work on the backside of bond issuances, the tax status is really essential to a bond in thinking about a bond. Is it a tax-exempt bond? Is it a taxable bond? Or is it one of these new instruments that we've seen grow in the last 4 or 5 years of a tax credit bond? Some of you might be familiar with, for example, a qualified energy conservation bond. It's not quite a tax-exempt bond, but it has some favorable tax treatment. The important part for all of these classifications is all of them can be greened. So the way of thinking about green bond classification doesn't have to be exclusive of all these other ways of thinking about bonds. And that's both exciting, but it can be somewhat confusing as well. I'm not going to go into a long definition of green bonds. There's actually different definitions out there, and there's different organizations that are referring to things differently. We are starting to see some standards develop, which my colleagues will talk about in a minute. But generally, the common attributes of something that is labeled a green bond are the proceeds to the bond goes to a specific project that has an environmental impact, or in the case of refunding bonds, it could be going to pay off the existing debt, but that existing debt was originally used for a green project. So a nuance there. Green bonds tend to have investors behind them that care about where their money is used for and are hopefully trying to drive their money into a environmental purpose. Often, but not always, you'll see an independent entity come in and assess the greenness, verify, certify. We'll hear more about that in a few minutes. And then the last one is quite important. Green bonds usually have an issuer, that is, whether it's a local government or a corporation, that's very, very interested in presenting themselves as an environmental steward. So those are some of the characteristics that we see. What green bonds may do, what we're seeing them do out in the marketplace, is potentially increasing the size of the investor pool. So you might have had a project that wasn't labeled as green, and once it becomes labeled as green, there may be some social investors or some environmental investors that would be looking at your project in a little bit different light. Again, similarly, it could just be new investors that in the past only invested in green tech startups or some type of environmental investment. Suddenly they realize that there is a whole world of municipal projects that have green attributes that they might be interested in. Green bonds are and tend to be a way of educating the public to get people a little bit excited about a bond, particularly environmentalists, about a bond that's labeled green as opposed to a bond that carries one of those titles that I mentioned a few minutes ago, like a municipal bond. Green bond attracts some attention. Now, the last two bullets on this are, you're right, you can see that they're contradictory, and that's because we're not really sure what's going to happen long term. Green bonds, there's a hope that they can reduce borrowing costs by tapping into new investors, potentially getting investors that might be willing to take a lower rate of return in exchange for the knowledge that their money is going to environmental purposes. But we haven't seen any dominating proof of that yet. We do know that doing green bonds takes some extra steps, which cost money. So in the short term, it's also very likely that doing a green bond may actually increase your borrowing costs, but you do get benefits that cover that. I will say that particularly for those of you in the finance world that work under very strict rules, and I know we have a number of different states represented on the call. I'm very familiar in North Carolina with the rules for issuing a bond in North Carolina. Because you label a bond green doesn't mean that you can somehow skip all of the other important processes that need to go in for issuing a bond. So really, to understand green bonds, you really have to also understand the entire bond world, all the rules. So for example, if you're in North Carolina, the local government commission is the king as far as approving debt in North Carolina and working with local government issuers. The fact that you want to do a green bond is not in any way giving you any kind of buy from any of the existing rules that are out there. I did want to have a clarification. We're getting a lot of questions at the Environmental Finance Center about social impact bonds. I'm not going to go into all the details of social impact bonds, just to say very quickly and clearly that social impact bonds are not green bonds. Social impact bonds are exciting financial instrument. They're not really even bonds, but it's a term that's being used. So what we're going to talk about today is green bonds. So maybe look for a webinar in the future about social impact bonds. I'm going to now just go over some quick examples to show everyone the breadth of the green bond movement. This is by no means exhaustive, but it does, I think, give you some idea of who's been the early adopters for this movement and what some of their green bonds look like. So let's start with DC Water and Sewer Authority. They have been an early adopter with a lot of innovative environmental and finance practices over the last few years. They were one of the first municipal public utilities to get into the green bond movement, and what you see on the screen now is some information related to a revenue bond that was designated as green that was issued in 2015. This was a bond whose proceeds went to support DC's very ambitious Clean River project. That project involves a range of infrastructure, both green infrastructure, distributed infrastructure, as well as traditional infrastructure. This particular pot of money went primarily to fund tunnels that will be used to mitigate against stormwater overflows. The greenness for this particular bond was assessed by a third party, and we'll talk a little bit more about what that means in a moment. You don't have to be a large capital to do green bonds. St. Paul, Minnesota advertised the greenness of one of their bonds. If you look at this bond, and this was done in 2015 as well, this is really a basic sewer municipal bond. So for those of you on the call that are involved with sewer system upgrades, you know, I think there are a lot of people that would claim that you've been issuing green bonds for years. Water projects such as projects that deal with failing wastewater treatment plants, deal with water systems, leaky pipes. Those all have green attributes and environmental attributes, and what St. Paul did, which I think a number of issuers are realizing, is that some of what they've done in the past would qualify as a green bond. In this particular case, it doesn't seem like there was a third-party reviewer. This was really a municipal bond where the local government themselves kind of took steps to designate as green bonds. Now, there's some controversy and discussion about how far you have to go in designing green bonds, which we'll talk about in a minute. But this is an example of a relatively small bond that has been labeled as a green bond. Green bonds are also been used for completely new purposes. So obviously we've been using bonds to fund sewer projects for years. The state of Hawaii found a very innovative use for one of their recent green bond issuances. This was done in 2014. This was a bond that actually was a taxable bond, unlike the other two. This was a bond that the state of Hawaii used to capitalize a loan program that will eventually allow private residents to put in clean energy installations on their private property. The fact that the proceeds from this bond will eventually go to support projects on private property make this a taxable green bond. The bond is backed by a fee that is assessed to all electric customers in Hawaii. It's called the Green Infrastructure Fee. It is also supported by loan repayments for people that participated in this project. So relatively new model, innovative on its own right. So you can kind of see that they're using this green marketing technique to acquire investors in an area that investors might not have been familiar with in the past. So interesting use there. There are many other examples of green infrastructure. If you go to the Climate Bonds website that I mentioned earlier, you'll see many, many examples. I just want to point out that we are seeing private corporate green bonds as well. The slide here is Regency Centers, which is a large property management company. You can see some pictures of some of their tenants where they've gone in and done specific green building upgrades using the proceeds of their green bond. This is a way to get investors that might not be interested in supporting, say, a property management company to know that this type of support would only go to specific types of use of their funds. In this case, green building. We're obviously speaking to you from a university. Universities have started to get excited about the possibilities of using green bonds. One of our universities just to the north of here, University of Virginia, recently did a large green bond issue. That one is interesting because, as I mentioned earlier, green bonds don't necessarily have to fund new projects. In the case of University of Virginia, the green bond that they issued was to refund debt that they had taken out in previous years. The key issue for them, and this was a green bond that was carefully monitored, was that they would only refund the portion of their existing debt that they could tie to buildings that were built to LEED certification standards. So an interesting kind of model for a green bond that is used to refund past projects. With that, I'm going to pass it over to my colleagues that are going to talk a little bit about the unique processes behind issuing green bonds.
Great, thanks, Jeff. This is Chris Wedding with Iron Oak Energy. So we'll get a little bit more into the weeds, as Jeff mentioned, on the process. What does it take in addition to the process for a normal bond to get a bond labeled as green, and then report on that during the bond's term. A bit of background on Iron Oak Energy. We really live at the nexus of finance and clean energy topics. So we work both in finance advisory as well as research. Our teams are mostly here in the U.S., but also some executives in the U.K., Japan, and Singapore. Solar for sure is a big focus for us. Increasingly, energy storage as well. We primarily represent the investor perspective and interest in these projects. And the nice thing, I think I was thinking about as listening, to you, Jeff, earlier, is that, for years the thought of, a green investment, often from an investor perspective, meant a sacrifice of returns for some sort of positive environmental mission. I think just to be very clear here, that's not what green bonds are about. Typically, it is the same kind of terms, yield, et cetera, risk of a normal bond, but you're getting to support a project with positive, public good type benefits, whether it's clean air, clean energy, or clean water. So in addition to helping investors find good solar projects, for example, to acquire, we provide the various types of analysis, both investment and energy, as well as policy related to those topics. Our Insights product, Iron Oak Energy Insights, a market research platform, provides content curation, trend analysis, as well as market briefing. So really trying to distill the massive amount of information out there to boil down to what it takes to act on some of this. I will note that the background for both my partner here, Chris Clement, and I, we're both graduates of UNC, and also I teach at the business school on topics related to the business and strategy behind clean energy and green building. Jeff mentioned earlier some controversies or debates in this field. By no means is everything worked out in the green bond space. Hence the topic for this webinar. I would say that on our Iron Oak Energy Insights platform, we do try and dig into some of these debates, shall we say, and that's a great spot to be, I think, because we think about years ago, doing doctoral work in the green building space, and it was very fragmented, a lot of question about what kind of green really meant, and we flash forward today where there are trusted standards like the LEED standard or Energy Star, and although they're not perfect, no standard will be perfect. They've helped to catalyze that market from niche to mainstream, where I think the estimates are 40–50% of new non-residential buildings are being built to green standards. The question is to what degree, at least when bonds will be used for projects that fit the criteria, how often or what percentage of those can classify as green bonds. Just a bit about, or just a snapshot here of who you'll hear from today. Myself, Chris Wedding, and then here next, as we start getting into verification, our director, Chris Clement. Stepping a little higher for a second, maybe 30,000 feet. Just want to highlight that there is a need for solutions like green bonds. If you think about the massive gaps in infrastructure finance in this country, we're talking about, as of projections from ASCE this year, almost $4 trillion of gap. You think about transportation, waterways, power, et cetera, needed by 2020. Many suggest that green bonds are a solution, not the holy grail, not the solution, but one solution to addressing that need. Similarly, from many of your points of view, states and cities need greater resilience. Often that means greater resiliency in infrastructure. Think about Sandy and other storms that have caused massive amounts of social, environmental impacts, as well as monetary damages. And then point number three, that bonds, as you all know on this call, are a very trusted finance mechanism for upwards of over 100 years, used to fund long-term capital-intensive projects like the ones we're talking about today, often with a public good focus. And it's large. It's a large market. So can it help address, again, not the single solution, but can it help address the pain points, the problems in points number one and number two from the prior slides? So let's get you guys engaged a little bit again. Hard to do remotely, but we'll try with another polling question. Are you actively involved in issuing a green bond in the next 1 or 2 years? Just kidding. That may not have been loaded properly. Many more great polling questions. That was a teaser, let's say, a teaser for future polling questions to come. So a bit more on context. The green bonds for cities and states fit within a context, obviously, of the broader global green bond market. So here we're looking back to 2009. If you look back a little further, 2007 and then 2008 with the World Bank, that was really the kind of beginning of what we today call a green bond. It really kind of bounced around on the bottom, if you will, until about 2013. It looks like massive growth, really, 2013 to 2014. Projections from a number of sources, Climate Bonds Initiative, Bloomberg, and others suggested upwards of $80 to $100 billion this year. We're at somewhere approaching 50 billion minor difference there. 50 billion this year, but the market is still very bullish on what's possible in the green bond space. Often there is a debate about whether the public sector or the private sector are leaders in new kind of financing mechanisms like this. I would say that the public sector is doing a great job to show what's possible. Here are two examples. One, the state of California from last year, $300 million, very, very long-term bonds. And I think that an important point to highlight is that although often buzzwords like solar and whatnot get most of the attention, most of the kind of photo ops, but really this can be used for a wide variety of projects. Here you see air pollution reduction, clean water, and then flood prevention. The Commonwealth, rather, of Massachusetts, they issued two separate green bonds. In part, they saw the market response to their first issuance, ended up raising $450 million in total. Very important point there, that second sentence there behind that bullet, 30% oversubscribed on the first $100 million, and then 3 times oversubscribed. That is to say, 3 times the number of investors who wanted to invest in those green bonds for their $350 million issuance that could not. So again, a sign of significant demand out there. And interestingly, the retail sector, so individuals becoming educated about what the state was doing, excited about that, and wanting to and able to participate. So empowering, say, the masses, if you will, to engage, to get behind big infrastructure projects in their backyard is another big possibility. Jeff mentioned earlier that better pricing is possible, though not guaranteed for sure. Their second issuance, this is for the state of Massachusetts, did see better pricing than a non-green bond for the same kind of tight duration of that particular day. And again, diversification for how those bonds would be used. Some more about the why behind at least these 2 states choosing to do this. One is to diversify the number and type of investors. The SRI investor class, socially responsible investor class, is growing. Raising more debt, raising debt more quickly, perhaps. We talked about educating the local constituents to get involved. And then part of what we're doing really with this webinar, really what UNC and the Environmental Finance Center does, what we do is to help the financial community and the environmental community better collaborate to accomplish mutual goals. With that, I'll turn it over to our director, Chris Clement.
Thank you, Chris. So earlier in the webinar here, Jeff described to you how green bonds have a lot of similarities with typical municipal bonds. And in the following sections, I'm going to try to outline how green bonds are different, and in particular, these 4 different processes that you would perhaps need to engage in if you were to issue a bond: verification, certification, disclosure, and impact reporting. So firstly, to verification. The big idea, the big idea behind verification is that there are both financial and non-financial or environmental expectations attached to a green bond issuance. And while the financial side can be fairly transparent, one of the big things that green bonds do is increase the transparency of the non-financial benefits or returns that a green bond issuance might generate. And so one of the leading sets of guidelines or frameworks that's been put forward to help guide this process are the green bond principles. This is something I'm going to describe in a little bit more detail in a moment, but suffice it to say that the green bond principles are a voluntary set of guidelines that was generated through a consortium of financial actors, large banks and investors, to help guide green bond issuances. And largely what the green bond principles do is it sets forth a framework that can help an organization align their sustainability goals and develop their own frameworks for evaluating a green bond. And it determines the use of proceeds, which is a term of art in the bond world, which is essentially a way of describing specifically what a bond issuance would be used for. And there are different types of, as there are different types of bonds, the use of proceeds can be as specific as particular projects, or as general as a program level sort of investment that would go to projects that were yet to be defined, and even to refinance prior investments, as Jeff mentioned a number of times. And the last thing the Green Bond principles really emphasize is this need for independent review, that not only are your internal teams, if you're an issuer, going to need to develop systems to track, disclose, and report on a Green Bond issuance, but independent reviewers are also needed to assess just how to assess your framework. So what might a so just a step backward in what are the Green Bond principles in a little bit more detail. As I described, they're the leading set of guidelines that the market is working with at this point to try to establish a framework for verification. But this is a voluntary standard. Green bonds, as I'll point out a little bit later, don't have to follow a verification protocol, but the Green Bond principles establish an easy way for issuers to do so. And essential to kind of the utilization of the Green Bond principles is this recommendation that external parties be used, and I'll get into who those external parties might be and how you might engage with them. So when Green Bond verification is something that an organization decides they need for the Green Bond verification is something that they need pre-issuance. What's often generated is what's called a second-party opinion. This second-party opinion is conducted by an external party, and it largely follows the framework that's put forth in the Green Bond principles. The Green Bond framework is something that the organization, the issuer, determines. It's essentially a general description of the impetus for why a Green Bond would be issued and what the use of proceeds may go towards. And then as the second party opinion evaluates the management of those proceeds, what systems are put in place such that the Green Bond framework can be realized in its full potential. And then the last 2 points are kind of the most critical points in terms of points of differentiation with Green Bonds. Transparency, monitoring, reporting, and verification are all kind of critical processes for Green Bond issuances. And the second party opinion evaluates the degree to which the framework sets in place protocols for those processes. And lastly, as Green Bonds are ostensibly about generating both financial and non-financial returns, there's often an environmental impact analysis that's included. These are the expected returns from the Green Bond, often at the pre-issuance stage. So in terms of Green Bond verifiers, there's quite a complex landscape of verifiers. I've listed some of the top ones here. As you can see, many of them are based in Europe, and though we have a couple in the U.S. or at least in North America. And apart from what the generally considered the top verifier, Cicero, all of these entities are for-profit organizations of one form or another. Cicero actually has a connection with the University of Oslo and is a research center and was connected to the World Bank's initial Green Bond offerings in 2008, and they've been a very large player in the space ever since. So if you were to issue a Green Bond and want to have a second party opinion, these are the types of groups that you would go to receive it. The arrangements are generally consultative in nature and run on the order of tens of thousands of dollars. So as mentioned before, it does add to your issuance cost, and that is a consideration. So getting into the data just a little bit, just to give you a snapshot. As I pointed out before, Cicero is very active in the space, and you can see the number of second-party opinions they've issued. But importantly, many green bonds don't have second-party opinions. They've not gone down the verification route, and that's an important consideration. It's not necessarily the market standard thus far. And in terms of who is serving who, you can see highlighted in the government sector, which is probably the most interest to you, that the government issuers are often served by nonprofit second-party opinion providers, though for-profit second-party opinion providers also provide some services in that space. So that will transition to green bond certification, which is distinct from green bond verification. But first, I'd like us to take a polling question. So our polling question is, for what would you use green bond proceeds? And this can be both specific to your organization or general interest. So the results are coming in. I think we'll close the poll. And we can see that fairly good distribution across green buildings, water infrastructure, clean energy projects, a little bit less in transportation and solid waste. That largely mimics the distribution of green bonds out there, so that's good. So certification, this is a little bit of a different beast than verification. So certification you can think of as a process similar to what the U.S. Green Building Council has established with their LEED standard. And this is what the Climate Bonds Initiative is trying to do with their Climate Bond Standard. The Climate Bond Standard and the Green Bond Principles are very complementary. They're not necessarily mutually exclusive. You can utilize both. But using the Climate Bond Standard does result in a certification that's based upon a standard that the Climate Bonds Initiative has created, and so the Climate Bond standards in general are providing a similar level of guidance to the Green Bond Principles, but with a much greater degree of specificity, particularly when it comes to evaluating the environmental impacts of a green bond. It's gaining market acceptance, and there's wide belief that the Climate Bonds Initiative will become the market standard, though it's not universally applied thus far. Though there is some risk, it should be noted, in working with the Climate Bond Standard, as there is the green bond market is still in its wild west phase, and it's yet to be determined if they will in fact become the market standard. So climate bonds are slightly different than green bonds. It's a slightly larger universe than green bonds, but this is the taxonomy that the Climate Bonds Initiative puts forward to describe the range of projects that may fall under their climate bond standard. But it's important to note that this is a work in progress, and that standards have only really been developed in the energy, transportation, and water space. And many of those standards are still being reviewed and verified by experts. So getting into the certification process, this largely mimics the process of verification, though at the end you receive a certificate that the Climate Bonds Initiative certifies. That the Climate Bonds Initiative certifies your project, as opposed to basing that standard on the reputation of a second-party opinion issuer. Just as one example of a climate bond certification, there's the very recently unveiled Water Climate Bond Standard. And as you can see in this diagram, this standard is distinct from the Green Bond Principles largely in determining a way in which to quantify the benefits of water projects in terms of their mitigation and adaptation benefits. If you're interested in looking further into this, there's information on the Climate Bonds Initiative website, and in fact a webinar that starts at 2 p.m. Just after hours if you want to learn more. And this was done through a consortium with Ceres and the World Resources Institute. So lastly, these two last steps are quite a bit simpler with the green bond disclosure first. So for both of these, I'll essentially report on the recommendations given by the green bond principles. And disclosure is something that can either be done on a project-by-project or on a portfolio basis. This is largely about reporting the good stories that follow the issuance and use of green bond proceeds, and goes towards meeting the goal of having higher degrees of transparency in what bond issuances are used for. And lastly, with green bond reporting. So green bond reporting can be considered either in the pre-issuance or post-issuance phase, and this is largely about trying to report on the expected environmental impacts over the lifetime of the projects being invested in, and this can be either done using your own set of methods or using the methods that are suggested in the climate bond standard or other such reporting and calculation protocols. The same types of activities can be done for post-issuance. However, this is not really being seen very much in the market thus far. In the recommendation that the green bond principles give with post-issuance is just that a common set of factors or metrics be reported on for a specific set of projects. So I've listed a number of metrics that would be specific to most likely a clean energy project, perhaps an energy efficiency project. And the recommendation from the green bond principle standpoint is just that there's comparability across projects such that we can get some ex post verification of how green bond issuances are generating both financial and non-financial returns. So that was a very quick high-level overview of some of the processes that you would need to consider in issuing a green bond. And at this point, I'd like to close with another polling question, trying to gauge what part of the process of issuing a green bond may prove most challenging for your organization. Thinking back to the 4 areas that we just discussed: verification, certification, disclosure, and impact reporting. So we're getting good results. I think we can close the poll. Sorry for those of you who weren't quick to the draw. And interestingly, we across verification, certification, impact reporting, good bit of concern about the challenge. Though impact reporting appears to be one of the largest concerns, and that does indicate one of the key distinctions between a green bond and a traditional bond is that there are a much higher standard for how you report on both the financial and non-financial returns that those bonds generate. So at this point, I would like to thank you on behalf of Iron Oak Energy for our contribution to this webinar. And I think I'll turn it over to Jeff to moderate some of the questions and answers.
Thanks, Chris. Well, hopefully everyone has a taste of some of the basics, particularly the folks that this is your first exposure to green bonds. So just to summarize, you saw that there's many types of green bonds out there still in its fairly developmental stages. There are some process considerations that are different than a traditional bond. We are curious what resources for those that are new to the bond space or those that have already worked in it. What kind of resources would you like from groups like ours that are tasked with supporting these types of instruments? So I'm going to put out a poll and just what green bond resources would be helpful to you, particularly in the future. And you can select, this is a poll where you can actually vote more than once. So you pick any of the list that you think would be helpful, and hopefully we can be part of the solution moving forward. Okay, we'll close out of that. I did want to say, particularly for those of you that said that you were interested in some type of in-person event, that if you're in North Carolina or can get to North Carolina, we're excited that the North Carolina State Treasurer is going to be doing a conference on sustainability and innovation that we're helping a little bit with. The date is April 7th, 2016. We will be advertising for them on their behalf through our listservs and through other channels. I just did want to highlight, I'm sure that the issue of green bond and capital acquisition is going to come up in that conference. So just a plug for that conference. Again, we do have some resources, and we are starting to use some of our traditional resources, particularly our blog, to discuss these green bond and other emerging instruments. So if you're interested in subscribing to the EFC blog, we've set it up so that with a click we can get you subscribed to our blog. So we'll put a poll out now. You just yes or no. We promise we won't sell your email address to anyone outside our organization, and it's about 1 or 2 posts that come a week, sometimes fewer. I'll let people vote on that for a second. Okay. And nextly, we did mention the Southeast Energy Efficiency Alliance. For those of you specifically interested in the green energy space, we'd like to give you the opportunity to get onto our newsletter and our mailing list specifically related to Southeast energy efficiency finance issues. And again, the green bond and green banks, which we've worked a little bit with, have been some of the key issues that we've been working with financial institutions and public entities throughout the Southeast. So if you're interested in that, go ahead and let us know about that. And lastly, our friends from Iron Oak Energy would be happy to give you a little bit more information about what they do. So if you'd like any information about what they do, just let us know. Okay, with that, we have a few minutes left to open it up for general comments or questions. As I said, we try to just go with written comments and questions rather than trying to go with anything over the phone. So if you have something, please type it in now. And I will say that depending on how many we get, we might not be able to answer all of them, but we will use these most likely for future blog posts and for other activities and education events that we might do. So even if you have anything on your mind, please let us know right now by typing into the question box.
All right, so our first question is, are there estimates of how much money is looking for a home in the regular municipal bond market and how much money is looking to invest specifically in green projects?
We don't have the number off the top of our head. I think partly because we focus mostly on the green bond market, less so on the broader bond market. But happy to follow up with detailed numbers to whoever that expresses interest.
But one interesting statistic is that the green bond market, even though it's exceeded $40 billion of issuances in 2015, is still a very, very small fraction, less than 1% of the total bond universe. And so, if you believe the argument that the green bonds have some appeal to investors generally, then we can expect that the green bond market will capture even a small piece of that larger pie and continue to grow.
I might also just add that if you look at the state of Massachusetts issuances of those bonds being 130%, 300% oversubscribed, it's less a question of how much oversupplied and the fact that, less a question of how much excess demand there is, and more to say that there is a need or an opportunity for those issuing green bonds to tap into that unmet or that growing demand out there.
The question, I'll just add, the question about the municipal bond market is it is a huge overall financial market for, if you just look at traditional municipal bonds. If you look at the amount of money that is invested in that. And it comes from all sources. It comes from pension funds, it comes from insurance funds, it comes from individual investors, institutional investors. It is a multi-billion dollar market, so it is sizable.
Thank you. Could you talk a little bit more about the risks of working with the climate bond certification standard?
I wouldn't characterize working with the climate bond standard as risky, though I can see how it would be interpreted that way. The climate bonds initiative are the clear market leader in designing a climate bond standard in collaboration with a really diverse array of partners, and so it has pretty broad market acceptance. The only consideration is just that as you know, if you follow the U.S. Green Building Council's LEED standard, it evolved over time, and to some degree, the value of that standard changed over time, and we could expect the same thing from a climate bond standard, that these standards are being prototyped for the first time and being applied to projects for the first time, and so to some degree, you know, if you worked with them, you would be electing to be a guinea pig of sorts, and so you know there's some risk to that, but there's also I would argue some excitement in being involved at an early stage with a certification system that could help govern activity in a really large and growing market.
Yeah, I would say that there's no perfect standard out there. You know, LEED actually is used as a kind of a type of verification for some green bonds that are issued. There's a group called the Capital Markets Partnership that we're working with actually on a business case document for the green bond market, along with a host of other institutions and financial organizations. They have a resilience standard. So there are a number of competing groups out there. Options to choose from, shall we say.
Can you share if any local governments in North Carolina have issued green bonds?
I am not aware of anyone that have gone through the full verification, but I don't know if...
I believe the city of Asheville has.
Okay.
I know they've issued a green bond. I would need to confirm whether or not they got that green bond verified.
But we are definitely getting a lot more questions about what it would take. So hopefully some of the folks on this call are considering doing it. I've talked to, in the last few months, at least 6 communities that have thought about going forward with a green bond.
How are the issued green bonds performing, and how does price perform relative to non-green corporate and municipal bonds?
So bonds traditionally kind of exist in 2 phases. You know, the issuance phase, where you scope out a number of buyers for the bond, and then in larger bond offerings in more established markets, you get secondary trading of those bonds. So the secondary markets for green bonds don't exist, at least thus far, and so the degree to which, you know, bonds have a performance metric, it's solely tied to their issuance. And so the evidence that we've seen is that depending on the bond and depending on the issuer, that there are some benefits to the issuer in the ability to raise more capital, or potentially to lower their cost of capital, meaning lowering the coupon on their bond. And since those bonds are sticking with the initial investors that bought them, there's no additional sort of verification of how they're performing. And in terms of environmental performance, there hasn't been any post-issuance assessment of performance apart from green bonds issued by development banks such as the World Bank, and they have an entirely separate sort of process to evaluate their environmental benefits. And the early evidence is that there are both significant financial and non-financial benefits to these issuances.
Okay, I think we just have time for one more. Could you talk a little bit more about the difference between a social impact bond and a green bond?
So social impact bonds, and we are by no means experts, are also referred to pay for performance. And the idea is getting private investors to find a social problem that they are willing to put capital up. And again, I'm not doing it justice, but it's almost a challenge. It's almost a challenge to innovators to find innovative, efficient ways to deal with a particular challenge, willing to put up money, private money that wants a return to help fund those initiatives. And if the impact of those initiatives goes through, then the investors are paid back. So it has some payback elements. So I think that's the idea of a bond, but it is not it's not structured and not really designed like a bond. And in that market, you're seeing, and there's been a few high-profile social impact bonds in some of the large urban areas to deal with social issues, health issues, childhood education issues. We are not seeing quite as much pay for performance and a social impact. We're going to bet money on a solution in the traditional environmental space, but there are some folks that are certainly working on that. So we may see that, and we may have a webinar on social impact bonds in the environmental space in the future.
Okay, well, I think that's all the time we have today. Thank you for joining us, and we hope you have a great afternoon.